Welcome to the weekly recap, brought to you by themortgagereel.com for the week ending January 16th. Inflation is no longer in the air, as the Feds have commented. So the concerns of inflation have regressed, and that's good for interest rates. It's also good for all of us at the gas pumps. So in a deflationary economy, unfortunately, we also face the fact of recession is here, and we have been in it. With this recession, coupled the major announcements from some banks as far as earnings and some also signs of weaknesses in the financial sector. We had the major pullout and a shock to the mortgage industry that Chase Bank pulled out of the wholesale marketplace. And why that is very significant is because they have been steadfast and very strong as one of the supporting lenders in the wholesale industry, and they pulled out completely. What's very reassuring to know is that a lot of other banks stepped up to the plate and have now come in to absorb some of that loss that we had. So that's a good sign, obviously, for the mortgage industry as far as brokers and correspondent lenders and some of the smaller banks out there that funded to Chase. Second thing we want to talk about is Bank of America. There has been a lot of concerns on Wall Street as far as what's going on with the acquisition and finalization of this purchase of Merrill Lynch. The Fed stepped in this week and basically threw them a $13 billion lifeline to complete the final purchase of Merrill Lynch. The Feds are now backing the assets and deposits that these two financial institutions had, so it's no longer becoming a worry. You have seen the stocks of Bank of America definitely take a hit on this news. How this is all translating to mortgage-backed securities. Just within the short time between the 8th and the 14th of January, the Federal Reserve's initiative to heavily invest in mortgage-backed securities, which we mentioned before, resulted in a number of about $23 billion. Now, so far, mortgage-backed securities purchased from the Fed is totaling $33 billion out of the $500 billion that they put out there to purchase from January until June of 2009. With that purchase and with that money being put out there, there's equal selling pressure. How that's translating to interest rates is a lot of people were expecting this announcement to say, oh, interest rates will go lower. And a lot of lenders started to announce that rates were going to go below 4.5%. Let's not get carried away. With the amount of money being put out there, there's equal selling pressure, if not some days more selling pressure than what's being purchased. So what's happening is we're seeing a flatline effect as far as the mortgage-backed securities and how they're trading, and then what's happening on a day-to-day basis. This can be looked upon as far as us as mortgage professionals as a breath of fresh air, because we're no longer having this wild volatility. It's somewhat of a flat line. With unemployment reports came out, in a traditional market, we would definitely see a lot of volatility and some changes intraday with interest rates. We didn't see that. And that's pretty much been because of this $4 billion per day initiative from the Federal Reserve to buy mortgage-backed securities. So we've pretty much gone flat. Now here's the thing. Inflation is tame right now, and deflation is here. It's fully expected, should the economy go into some type of recovery and at least stabilize, that inflation will return. With inflation, we saw where interest rates were for the past 18 months until this point. Coming into the final parts of 2008 in December, interest rates were in the 6.25%, 6.5% range, and now they're at that 4.625, 4.5 range. So we don't want to send out any alarms, but we also want to say, if they're buying until June, unless the stimulus package announced next Tuesday by President-elect Barack Obama when he officially takes his seat, that stimulus package, unless that changes anything, we potentially see some of this volatility returning again in the later part of this year. And if inflation starts to become a concern, unfortunately, we will see interest rates start to increase. And what is that also going to do? Well, gas obviously is one of the biggest concerns as far as oil in the global production. We'll see the gas prices begin to increase again. So we want to make sure this is an opportunity right now where if you're in an adjustable rate mortgage, if you're in your home for the long term, if you're planning to move in the short term, definitely calculate when is it the break-even point and when you'll see the actual savings of refinancing or purchasing in a market that's offering these low interest rates. Two things coupled. When the interest rates are low, obviously buying power is stretched further. we want to refer you back to home buyers education to make sure to understand when is it your break-even point. We also posted one is when is it best to buy down your interest rate and pay those points. Both of these are great informational pieces to really understand when is it the right time, when is it best for you. A lot of people just follow the masses, and a lot of times they don't understand what they're getting into, and when they see that good faith estimate and then they see the final closing cost, it's a shock. And we want to prevent this shock from happening. We really want you to understand what you're getting into, the numbers that you need to see, and when is it the break-even point. When are you actually going to come ahead and start making money? So please refer to those, because we have those up free as for everyone to definitely take advantage of as a tool. Going into next week, obviously again, the inauguration is setting world history. And it also sets in that there's not too much economic data coming out. However, we are in earnings seasons from the fourth quarter, meaning retail sales, Walmart, a lot of companies expected to release their earnings. And with these expectations not being met from Wall Street, we'll see a deterioration in the stock market. Should that deterioration hit heavily, mortgage-backed securities is that safe haven where that money will come. And with that influx of money into mortgage-backed securities, the yields come down, which brings the interest rates down. Now, how that really couples is if you're waiting for a refinance with no closing costs. Should you see that start to happen and mortgage-backed securities benefit from that, that could mean that you're probably waiting right now for the right time to refinance without closing costs. That may come. Here again, it has to be the right timing. You have to time this right. You have to be working with a mortgage professional that has the tools at their hand to really understand when is it the right time and when is it the right time to really pull the trigger to lock that interest rate in. Last forewarning is that you'll see a lot of lenders now going at least minimum 45 days. We are hearing on the streets that a lot of the biggest banks, Wells Fargo, Bank of America, are now stretching their refinancing times from 60 to 90 days. I mean, it's taking up to 90 days to complete that refinance. So with that said, that just represents the influx of volume that they're having, and because of the cutbacks that all the banks did on staffing, now they're just, you know, the overwhelming response of applications, they're not able to keep up those volumes, which increases that turn time. This affects interest rates because the longer you have to extend out your lock period, the margins decrease and the interest rate can be affected. So we just want to make sure you understand that. If you have any questions at all, please feel free to contact us at info@themortgagereel.com or simply blog below with any of your questions, and we'll definitely reply back and answer those immediately, because this is a time where information is empowerment, and empowerment will make the difference of having a sound financial investment or an investment that you might have walked into not knowing what you're getting into, and then having a great big sticker shock when you see the final documents. Thank you very much for tuning in, and we'll talk to you next week.